Hello, I'm Hendri de Klerk from Ultima Financial Planners. Welcome to our video on bonds. Our team put together this video to help you gain a better understanding of the inner workings of bonds. Before we get started, I would like to disclose that Investopedia.com was used as the main source of information used in this video. Secondly, the video is intended for information purposes and does not constitute financial advice. Please reach out to your qualified financial planner or advisor regarding your specific situation before making any investment decisions. Now, what is a bond? Bonds are an asset class widely used in investment portfolios. A bond is a loan instrument, but not the loan used to fund your primary residence. When you buy a bond, you are lending money to a company or a government. In return, they pay you interest regularly. When the bond's term ends, they pay you back the amount you've lent them. The regular interest payments you receive are called coupons. Hester will explain to you why bond prices change.
Hello, I'm Hester van der Merwe. Let's talk about why bond prices change. There are three key reasons why bond prices move up and down: prevailing interest rates, the issuer's financial stability, and decreasing time to maturity. Prevailing interest rates are the main reason why bond prices change. When interest rates go up, bond prices go down, and vice versa. This happens because a new bond with a higher interest rate will be more attractive than an older bond with a lower interest rate. The issuer therefore must be compensated on the bond price for the fact that the interest rate has changed. The issuer's financial stability. Bond prices also change based on how financially stable the company or government that issued the bond is. If investors think the issuer might have trouble paying back the bond's price goes down. Credit rating agencies like Standard & Poor's and Moody's rate the financial stability of issuers. If they lower the rating, the bond prices usually drop. And then the decreasing time to maturity. At maturity, the issuer pays back the value of the loan. The time left until the bond matures therefore also affects its price. As the maturity dates gets closer, the bond's price moves closer to its face value. Gerrit will now delve into the details on why bonds are such a good asset class to provide clients with an income.
Hi, I'm Gerrit Viljoen from Ultima Financial Planners. Why is there such a good opportunity currently in bonds? As Hester mentioned, bond prices go up when interest rates go down. Right now, interest rates are expected to decrease globally because inflation is under control. This means bond prices might increase and bondholders will still earn good interest. This could be a great time to talk to your financial advisor about adding bonds to your portfolio. Speak to your qualified financial planner or advisor about the opportunity within bonds and see if they could add value to your portfolio. At Ultima, we believe bonds can be a great addition. Great, now since we've heard from Hendri what bonds are and from Hester on what conditions bond prices increase or decrease, basically interest rates rising or decreasing. We just now look at a practical example on the left-hand side representing bonds. We look at an apple tree where we harvest apples, let's say, once a year. And on the right-hand side, we're looking at equities or a big, huge tree growing for 40 years. Then we chop it down and sell the wood. But when we look at income funds and a specifically dynamic income fund, it's basically something of both where we combine both of these. Now, when we look at these funds, we can further see that the green part on this graph shows us the interest rate that's paid, and we can see basically on the bond side it pays you almost like 10% right through. We see that the orange section represents capital return. Now, either the capital is added when it increases, the bond price increases, or the capital decreases, and that resultantly would bring down the total return of the fund in that year. So it's not a one-way street. We see that you can add capital through capital appreciation to the interest you receive of a bond, or it can detract of the return. And the grey sections here will show what the resultant is. Now, if we look at what the bonds did since 2001 up until 2023, it's basically a 22-year period. Over this period of time, we can see the interest that's been paid out on the bonds, and at the bottom we can see what the resultant capital return was. Now, looking at the net result over that period of time, we can see that the income alone gave us 714%. The capital, when we added or subtracted it, detracts about 5%, which gives us a 710% return over the 22 years, which is not bad. But now looking at it a little bit further, we can see this white just represents the USA, US Treasuries, and we see the green part is our South African bonds, and the green is the dynamic income fund, which we are talking about. Just on the right hand side, we can see US Treasuries. This axis is the risk side. So the more right hand side it is, the more risky it is or volatile. You can see the values are going up or down. So the US Treasuries are giving us the worst return in rands and also the highest volatility. There you can see how it goes up and down. And then the South African bond market gave us quite a good return over that period of time, whereas the dynamic income fund with the least volatility, and we can see that in that graph as well. So just to sum up, since 2015, the dynamic income fund gave us 10.2 per annum, and these are all the asset classes you could have invested in except offshore equity, and even the bonds gave us the second best return, but with a lot more volatility. Now this just sums it up. Over a 1 year period of time, the dynamic income fund gave us 15.1, great return, where all the peers only did 11%, and the bond index gave us 15.6. But looking at it since inception, 2015, money market only gave us 6% per annum, and the dynamic income, as we saw, gave us 10.2. Now this just puts it in another perspective. These are all the income funds available on the market, and people ask us, how did the dynamic income fund do against its peers? There you can see on the left hand side, that's the dynamic income fund. This is the average one, where the dynamic income fund outperformed it by 1.5 times, and the worst fund, the income fund, outperformed that by 2.8 times. Now this just shows us what happens when we were last at a point in time looking forward with interest rates as high as 11.6%, as we saw previously, that it's difficult to predict what equities will do in the next 2 years. It could be as high as 25% or as low as -1%, but we can see that specifically the dynamic income type of funds, the next 2 years, when we move from a place where we are now, gave 18.1% per annum. Now this, I think, will give it to you a little bit in more perspective, because where we are now, we expect the interest rates to decline, which should give us the increase in the capital value as well. But let's say interest rates rise and they don't fall in the next year, then we will see our resultant interest rate on that fund will come down to 8.4% from the 11.87% where we now. And should interest rates rise by 200 basis points or 2%, we will even do worse, where we can only expect 5.5%. Still not negative, but it's not what we really want. But if interest rates drop 100 basis points, which is 1%, the next 2 years, the return would be 15.3% per annum. And should interest rates drop by 2% or 200 basis points, we can expect a return of 19.3, which is very satisfactory. So when we're looking at the current yield, it is at this point in time too risky not to buy bonds at the current yields, because we see that we stand to gain quite a lot if interest rates come down. Now I want to get to this situation where we deal practically with clients' money in retirement. Now you can see from this graph that the market dropped in COVID about 34%. Now once the market has dropped 34%, it should not rise 34% to get back to that level. It should rise 68%. But if you sell units, and remember we have to sell the units to pay the income, you have less units down here. So you don't need 68% to get to the top. You probably need that fund to do about 75% to only even get back to where you were. So this is why it's so important, why we need something in the fund that will provide something like interest or property, which gives you also an income, but we're talking about something that will give you an interest. So what I want to share with you now, if we look at an equity like the global equity fund, we start off with an amount of units and we look at the unit price. If we multiply that, we get a resultant rand value, and you can see that 271, but that's cents, so it's 2.71 rand. If we look at that, we see there's an outflow over the period, and this is a year. So we started with 348,000 units, but we end the year at 335. So if we also pay an income out of this fund, we see we just constantly losing units. But when we then look at a dynamic income fund, we start with units at 1,653,000. and the price is 1 rand and 1 cent. Remember, it's in cents, so we have to divide by 100, and then we get 1.677 million. Now we have payments, annuity payments, but then we have every quarter a reinvestment of units. So there it's an addition of 45,000 units or 44,000 rand. The price went down. Why did the price went down? Because normal interest rates went up, but we received 44,000. The next reinvestment came in January, 45,000 units at the price was 1 rand 1 cent. So we see 45,000 rand was added to the fund. But what's also very interesting, over this period of time, we see that the price increased from 1 rand to 1 rand 7. That's where the capital value is. Now this is very important, and why we want to just show you that this is important for us to replenish the units, because we started off with 1.6 million units and we ended up with 1.768, even though we paid an income, but we received great interest over that time, and the interest payment of the component of capital growth and interest was about 11%. So this is why it's important for us to structure a portfolio correctly, so that we don't just lose units, but we get great interest in that respect as well.